This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, this is the second lecture on share options and option pricing. In the previous lecture, I explained what share options were, and I finished by talking about factors that would influence the premium, the price that we're charged to buy an option. And as you can see on the screen, there are the formulae we use. It's Black-Scholes option pricing method. They came up, Mr. Black and Mr. Scholes, they came up with a formula for calculating the price of a call option. Now you're given these formulae on the formula sheet. So it's a combination of, well, being clear what the symbols mean, because as always you're not told the symbols in the exam. So being clear what the symbols mean, and then obviously being efficient with your calculator. And I have said in an earlier lecture, and here it becomes critical, you've got to have a scientific calculator. You cannot possibly do this in your head. That first formula, C, this is the value of a call option. And I've listed all what the symbols mean below. That PA is the current share price. We've said that is one factor. I said in the last lecture. PE is the exercise price. E is a constant. It's like pi. And if you've got a scientific calculator, you will have an E button. That's all you need. You don't need to remember how much E is. It's 2 point something. I can never remember. R and T. R is the risk-free rate of interest. So if the risk-free rate is 5%, it's 0.05. T is the time to expiry in years. So if you can exercise the options in 3 months' time, that's 3/12, a quarter of a year, or 0.25 of a year. N, as you'll see, is telling us to look things up in the standard deviation, in the normal distribution tables. We looked at them briefly earlier with value at risk, and you're given the tables, and I'll show you how to use them again. But that's what N means, look things up. But the figures we look up are D1 and D2, and you've got these other formulae here. D1, ln is log to the base C, but again, with a scientific calculator, you'll have a button for it. PAPE we've dealt with, R we've dealt with, S. S is the volatility, it's the standard deviation. I've mentioned that when we did value at risk, you'll be given the standard deviation. T we've already dealt with, time to expiry. Finally, D2 needs D1. It's whatever you get from D1 minus S root T. So it is purely a calculation exercise, which some people love, because that's all that's involved. Other people hate, because it's such an enormous formula. All I can do is show you with 1 or 2 examples how we stick the figures in, how we actually use it. So, can you look at example 3, please? And first of all, let's make sure we're happy all the symbols we're using. Where is it? I'm trying to find the formula sheet again. Here we are. First of all, it says the current share price is $2.90. So PA, I prefer to work in cents all the way through, and the answer will be in cents. So I'll put 290. If you want to put 2.9, won't make any difference, but your answer will be in dollars. The exercise price is $2.60. Well, that's PE. So working in cents, 260. It's exercisable in 6 months' time. So that's the time to maturity, the time to when we exercise it, which is T. But I did say, you always do this in years. So 6 months is half a year, or 0.5. The risk-free rate of interest is 6% per year. So that's R for the formula. 6% as a decimal is 0.06. And the standard deviation of the rate of return on shares, I said when we mentioned standard deviation before, you'll never be asked to calculate it. You'll be given it. This is S. It's 40%. We write it as a decimal, 0.4. So now we've got everything we need. And part A asks us for the value of a call option. Well, the call option formula has this ND1, D2 in it, and so we need to calculate them first. So first of all, D1. I hope you've got the formula in front of you, and just check you're happy where the figures go. It's ln log to the base E of PA 290 over PE 260 plus R 0.06 plus 0.5 times S squared times T 0.5. Divided by S 0.4 times the square root of T, the square root of 0.5. So far no problem. Now let's do the solving. Log 290 over 260. I've got an ln button, so ln brackets 290 divided by 260 comes to 0.1092 plus, I'll try and do all of that at once. If I start at the end, it's 0.4 squared times 0.5 plus 0.06. So the bit in the bracket, I end up with 0.14 multiplied by 0.5. That's 0.07. Divide by, well, the square root of 0.5, it's 0.707 something, times 0.4, 0.2828. And so what do I end up with for D1? 0.1092 plus 0.07 divided by 0.2828. I get 0.6337. And incidentally, although the marks in the exam are more for approach than accuracy, make everything mistake, you'll lose the odd mark, but it's approach. So as always, make sure you're showing your workings properly. Also, though, here, I would actually, for the moment, keep things to 4 decimal places. It's not critical, but a bit of rounding can end up making quite a big difference. Anyway, that's D1. For that first formula, I also need D2. And D2, again, it's on the formula sheet, it's equal to D1 minus S root T. Well, we've got D1, 0.6337, minus S root T. Well, I already worked it out, in fact, but let me double check. It's S root T is the root of 0.5. times S 0.4, as I was right before, 0.2828. And we end up with 0.6337 minus 0.2828, 0.3509. Now then, having calculated D1 and D2, if you look to the first formula, it's P8 times N D1 minus PE times N D2. Well, now I need to explain what it means, N brackets D1. What it means, we look up D1 in the normal distribution tables. Now, in a minute, I'm going to have to add something to that. This is awful. But just check what I mean. That we got D1 to be 6337. Now, when you come to use normal distribution tables, we've seen them before, but I'll check you again. You can only actually look things up to 2 decimal places. So it may seem to contradict what I said before, but it does actually matter. When you actually come to look it up, go to 2 decimal places. So 6337 is the 2 places 0.63. So we're looking up N 0.63. And the way we look it up, we look up directly. Last time we were working backwards. But down the left-hand column is to 1 decimal place, so 0.0, 0.1, 0.2, 0.3, and so on. Along the top is the 2nd decimal place. So for 0.63, first place is 0.6 down the left-hand column, so it's that row. And as you move along, we've got 0.60, 0.61, 0.62, 0.63. I get 0.2357. However, there's a little trick here. You look up from the tables, we've done it, but look what's typed at the bottom of the tables, and this is what you get in the exam. It says the value can be used to calculate N brackets D, the cumulative normal distribution functions needed for the Black-Scholes model of option pricing, if D is greater than 0, we add 0.5 to the relevant number. If D1 is less than 0, we subtract the relevant number from 0.5. Now you may be wondering how it can happen. You'll see in the next example. But in fact, D1 and D2, the answer here, they were both positive, but they could end up being negative, particularly D2, because it's D1 minus something. Well, you can end up with a negative number. Now here they're both positive, and if they're both positive, oh sorry, if either's positive, D1 is positive, the rule is you look up the figure in the tables, 0.2357, you then add 0.5. And so the answer we need for this bit is in fact 0.7357. There is ND1. Now, as it said, had you got D1 to be negative, just watch what would have happened. Had it been minus 0.63, you still look up 0.63 and we get that. But had it been minus 0.63, you then subtract this from 0.5, which would end up giving 3, 4, 6. I think it would end up at 2643. Now it isn't negative, obviously, so that's there irrelevant. But be clear, you look up the positive number, whatever. So if D1's 0.63, you look up 0.63. If it was plus 0.63, you add 0.5. Had it been minus 0.63, subtract what you get from 0.5. Okay, well here it was positive, so I can't, my erasing stopped with, oh no, here we are. Anyway, we nearly there, we've got ND1. In the same way, let's look up ND2. D2 was plus 0.3509. Again, we have to go to two decimal places here, so plus 0.35. What do we get this time? 0.3 down the side, so the 0.3 row. Move along the 0.05 column. I get 0.1368. And again, the same rule applies. Since this was positive as well, plus 0.35, we add 0.5 to the figure. Now, I better just mention some answers you look at, in study text revision kits, try and be very clever and say, oh, well, it wasn't 0.63, it was 6337. And so they look up 0.63, they look at 0.64 and sort of approximate between them. Well, fine, there's no need to in the exam, there really isn't. If you want to approximate between 0.63 and 0.64, all right, it's slightly different obviously, by all means do. Similarly here, it's like a tenth of the way towards 0.36, so you could approximate between the answers, but I'm not interested. What I do care about, of course, is the final answer, C. We've now got everything we need. So C is PA, which I've forgotten by now. The current share price was 290, times ND1, 0.7357, minus PE, the exercise price, which was 260, times ND2, 0.6368, times, now here's the last messy bit, E, which is a constant, as I said, you need an E button, to the power minus RT. R was 6% 0.06, T was 6 months 0.5, so R times T, I'm throwing bits of paper on the floor here, R times T, 0.06 times 0.5, it's minus 0.03. So, now off we go. First bit's easy. 290 times 0.7357 is 213.35. The last bit though, now you've two choices here. We need e to the power minus 0.03. Well, with a scientific calculator, that really shouldn't actually be a problem. If you do have problems with your calculator, then anything to the minus power, I think you should know from school, anything to a negative power is 1 over the positive power. So e to the minus 0.03 is another way of writing it's another way of writing 1 over e to the power 0.03. So it's your choice. Check both on your calculator. Don't wait until you get into the middle of an exam to find out you're having calculator problems. And in fact, just hopefully to make it easier for you to check me, I will write it as 1 over e to the power, the positive power. Oh, save any confusion. Times 1 over e to the positive power. Well, 260 times 0.6368 is 165.568 times, well, 1 over 0.03 e to the power equals, oh, sorry, my calculator's gone and messed it up. 1 divided by brackets e to the power 0.03, which is 0.9704. So now we've got it 213.35 minus 160.67 finally gives me the value of a call option, 213.35 minus 160.67. 52.68 cents. Remember, I did the whole thing in cents from the beginning. And so if we wanted an option to buy, the right to buy these shares at 260 in 6 months' time, we'd have to pay 52.68. And that does actually, I'm not surprised at the size of it. You see, if you had the right to buy this share immediately, price is currently 260, share price is 290. I said earlier, you'd have to pay 30 cents. We've got the intrinsic value, but you'd have to pay 30 cents. We've got the same right, but not for 6 months' time. And in 6 months' time, obviously, the share price could be a lot higher. And so I'm not surprised I have to pay more from the option. Pay 52 cents now, and in 6 months' time, it'll be my decision whether to exercise or not, depending on what's happened to the share price. I've also asked the value of a put option, part B, which is less likely in the exam, partly because to get the price of a put option, you'll see the formula on the formula sheet, it's called put-call parity, but you need to have already worked out the price of a call option. That the price of a put option is the price of the call option minus PA plus PE, again e to the minus RT. Well, we've worked out the price of a call option, it's 52.68 cents. Remember, I'm doing everything in cents. It's minus the current share price, PA, which is 290, plus the exercise price, PE, which is 260, times, well, again, 1 over, if you want to do it this way, e to the power 0.03. E to the negative power is 1 over e to the positive power. So 52.68 minus 290 plus 1 divided, I did this before, did I write it down anywhere? Yes, I did, 0.9704 which is 52.68 minus 290 plus 260 times 0.9704, 252.3. So finally, what do I get? 52.68 minus 290 plus 252.3. 14.98 cents. And there we are. Now, say a put option's less common in the exam because you're repeating all the work in a sense. Again, an answer's an answer. There's not much point in standing discussing it, except, why is it cheaper to buy a put option? They're charging less because, appreciate, you're only going to exercise it if the price fell below the exercise price of 260. And there's a lot less chance of that happening. The price is currently 290. Share price is usually more likely to go up than down. Exercise 260, we have to pay a lot for the right to buy the share. But as far as the right to sell it is concerned, well, it's already 290, so it's going to have to go down below 260 before we'd even exercise. And so it's less likely to happen. And so I'm not surprised they're charging less for the option. Well, there we are. And I'm sorry that took a while. I know if you're good at figures, then I took far too long over it. Otherwise, I hope I made it clear what goes where and how. So do make sure you've got it. There is a second example here. Example 4. I do suggest you have a go and check with the answer at the back. I'm not going to do it on the screen, but there is an answer in the notes. Do have a go. There is one more lecture to do with what we call the Greeks and delta hedges.